Welcome back to the deep dive. Today we are shifting gears a little bit. We often talk about tech giants or massive infrastructure projects or, the shifting sands of geopolitics.
Right. Big picture stuff.
Exactly. But today we are tackling a subject that, quite honestly, usually feels like pure, unadulterated chaos. And I mean that in the most loving way possible, of course.
I think I know where you're going with this.
We're talking about parenting. Or more specifically, the business of parenting.
It is a chaotic business.
Yeah.
And honestly, business feels like too clinical a word for what it actually is. It's survival.
It really is. I mean, if you've ever tried to leave the house with a newborn, you know exactly what I'm talking about.
Okay.
It's not just a departure. It is a tactical mobilization. You need diapers, wipes, 3 changes of clothes because, accidents happen.
Oh, wait.
A specific pacifier because the other one is suddenly wrong. A carrier, a stroller. And that's just for a 20-minute trip to the grocery store to buy milk.
And the thing that people don't tell you is that the logistical nightmare doesn't end when they start walking.
Not at all.
It lasts for about 12 years. The gear just changes. You trade the diaper bag for the soccer kit or the science project supplies or, that specific brand of trendy water bottle that every kid in middle school suddenly needs to have.
Exactly. It's a 12-year marathon of procurement. And today, we are diving into the company that has effectively positioned itself as the infrastructure for that chaos in India. We are talking about FirstCry.
Or, to give it its official name, Brainbees Solutions Limited.
Right. If you want to be formal and look at the stock ticker, it's a company that I think a lot of people just assume is a website.
It's another e-commerce store with a cute logo.
Yeah. But when you peel back the layers, and we have a lot of layers to peel back today, it is something much, much bigger.
So much bigger. We're looking at sources that describe it as the Amazon of baby care for India and increasingly the Middle East.
That's a huge title. But here's the stat that absolutely floored me right off the bat. Before we even get into their revenue or their stock price, listen to this.
Okay.
FirstCry has distribution partnerships with over 5,000 hospitals.
That is the killer statistic. That's the one that makes you just, sit up and pay attention.
It's wild. Think about the implications of that for a second. Before a baby even goes home, before the parents have even figured out how to install the car seat without pinching their fingers.
Which is a whole adventure in itself.
FirstCry is often already there, literally in the room with them.
It's a strategy called Capture Early. And it is incredibly difficult to pull off. In most retail sectors, you are fighting for intent.
What do you mean by that?
Well, you're waiting for someone to realize they need a pair of running shoes, and then you fight for their attention on Google Ads. You bid on the keywords.
Right, you're trying to catch them at the moment of decision.
Exactly. But FirstCry has managed to operationalize a way to bypass that whole process. They aren't waiting for you to Google where to buy diapers.
No, they're already there.
They are handing you a gift box in the maternity ward. They are establishing the relationship effectively at birth.
It feels almost unfair to the competition. I mean, how do you compete with someone who shook hands with the customer on day one of the customer's life?
You really can't. And that's the point. This isn't just retail. This is about becoming the default setting for parenthood. It's about becoming infrastructure.
And the market values that infrastructure pretty highly.
Oh, absolutely. If you look at their market cap as of February 2026, we are talking about a company valued at over 14,000 crore.
Which is massive. I mean, that puts them in the big league.
It is huge. But, and this is the but we are going to spend a lot of time on today, despite that dominance, despite being in the hospital room, despite the billions in revenue,
Here's a catch.
they have had a very, very hard time turning a net profit.
And that is the mystery we are here to solve. How can you be the dominant player, the Amazon of baby care, and still struggle to keep the money in the bank? You would think with that kind of market share, they'd be swimming in cash.
Well, it comes down to a few things. The cost of growth, some really intense competition from new players, and some very aggressive bets on international expansion.
Okay.
But there's also a secret sauce in their business model that I think most people completely miss.
The secret sauce. I love a good secret sauce.
Yes. Everyone thinks they are a marketplace, like Amazon or Flipkart,
Yeah.
a platform where other people sell things.
Right. A big digital mall.
But when you look at the data, they're actually something else entirely, just disguised as a marketplace.
Okay. I love a good disguise. So our mission today is to unpack this beast. We're going to look at how an Indian startup grew into a multinational giant, why the profits are so elusive, and what exactly the secret sauce is.
Let's dive in.
So let's start with just the sheer size of this thing, because online store doesn't really do it justice, does it?
Not even close. When we look at the source material, the scale is, it's just mind-boggling. They have over 1.5 million product variations. Sex.
1.5 million. Let's just pause on that number for a second. That's a universe of stuff.
It really is. And you can't get to 1.5 million with just diapers and wipes.
No way. That's not just hygiene products.
No. That's the thing about the baby category. It sounds niche, right? But it's actually a super category that encompasses everything.
How so?
It's apparel, footwear, feeding bottles, furniture, school supplies, toys, books. They've even expanded into women's beauty and personal care.
Ah, so they're going after the mom's wallet too.
They're trying to capture the entire household spend related to the mother and child, from cradle to, well, almost to college.
It's essentially a department store that follows you around for a decade.
That's a perfect way to put it.
Yeah.
And the number of people buying this stuff is growing incredibly fast. We're looking at data up to March 2025, and they had hit nearly 10 million annual unique transacting customers.
10 million families. That is 1 crore families.
Just try to imagine the logistics of serving 1 crore families, and look at the growth rate. They jumped from about 6.8 million customers in fiscal 22 to over 9 million in fiscal 24.
Wow.
That is a 33% increase in just 2 years.
In a market that some people say is slowing down, or at least a market where the birth rates are stabilizing.
Well, the fertility rates are dropping, which is a big macro trend we will absolutely get to later. Yeah. But FirstCry is growing its share of the wallet way faster than the population is growing.
They're capturing more of the existing market.
Exactly. And financially, that translates to serious revenue. For the fiscal year 2025, their revenue hit 76.6 billion.
76 billion rupees.
And that's 18% year-over-year growth.
And what about GMV, the total value of stuff sold?
The gross merchandise value, or GMV, for that same year was over 10,585 crore. These are phone number-sized numbers.
They really are. But to understand how they're doing this, you have to look at their omni-channel strategy. Now, I know omni-channel is a buzzword that every CEO loves to say.
It is. It usually makes people's eyes glaze over.
It really does. We are an omni-channel experience. And usually that just means they have a website and maybe a few pop-up shops in a mall somewhere that sell T-shirts.
Right. It's marketing fluff. But for FirstCry, it is actually the core of the engine.
Okay, so break it down. What does it mean for them?
So about 78% of that massive GMV comes from online sales. That's the app, the website, the usual suspects.
Digital side.
But the other 22% comes from offline.
Yeah.
And that 22% is coming from over 1,000 physical stores.
Wait, 1,000 stores?
Over 1,000.
That's not a few pop-ups. That is a massive retail footprint. That's closer to a fast food chain's presence than a typical e-commerce startup.
It's a mix of company-owned stores and a lot of franchises. But here's the fascinating part, and this is where the tech part of Brainbees Solutions really comes in.
The Brainbees part.
Exactly. They don't just open a store and stuff it with random products based on some generic corporate planogram.
Yeah.
They use what they call the depth strategy.
Depth strategy. Okay, break that down for us. Because usually retail is a guessing game, right? You buy a bunch of winter coats and you just hope it gets cold.
Right, and then you have a massive sale in March to get rid of them. But because FirstCry has millions of people searching on their app every single day,
yeah,
they have this incredible granular data.
Down to the neighborhood level.
Down to the zip code level.
Okay.
They know what parents in a specific zip code in Mumbai are searching for versus what parents in a specific zip code in Jaipur are searching for. They can see the intent before the purchase even happens.
Okay. So they are essentially reading the collective mind of the neighborhood.
Precisely. So when they decide to open and stock a physical store in that neighborhood, they are not guessing.
They already know what people want.
They use the online search data from that specific zip code to decide exactly what goes on the shelves in the physical store.
That is actually incredibly smart. It seems so obvious when you say it, but I don't think anyone else does that at this scale.
It's very hard to do unless you have both the online search volume and the physical footprint.
So if my neighborhood is obsessed with, say, organic cotton onesies and wooden educational toys,
then the FirstCry store down the street is going to be packed with organic cotton onesies and wooden toys.
Exactly. And if another neighborhood is searching heavily for, I don't know, budget-friendly strollers and bulk diapers,
that store will reflect that demand. It's data-driven physical retail. And think what that does to your business.
it must slash your risk.
It reduces the risk of dead inventory stuff that just sits there and never sells. And it increases the turnover. It makes the physical stores much, much more efficient than a traditional retailer who is just following a corporate mandate from headquarters.
It's like the internet bleeding into the real world. You
Yeah.
walk into a store and it feels like it was curated for you because, in a way, it was curated by you and your neighbors.
That's a great way to put it. And it creates this powerful loop, right?
Right.
You see the brand online, you trust it. Then you see the physical store, you walk in. The store has exactly what you want because they knew you wanted it before you even walked in. It just reinforces the loyalty over and over.
So they have the scale, they have these incredibly smart stores. But you mentioned a secret sauce earlier, something that makes them different from just a reseller.
Yes.
Because right now, they sound like a very, very smart version of a Target or a Walmart for babies. And while those are great businesses, retail margins are notoriously thin.
And that is the central misconception about their business. Most people think FirstCry just sells Pampers, Lego, and Chico. And look, they do sell those things.
Of course, you have to.
But if that's all they did, their margins would be razor thin. They'd be in trouble.
Retail margins are brutal. If you sell a pack of Pampers, you're competing with the grocery store, the pharmacy, Amazon, everyone. There's no pricing power.
Exactly right. If you sell a pack of Pampers, you're making maybe a few percentage points of profit. You can't mark it up because the customer knows exactly what it costs everywhere else.
So what's the secret?
The nugget that jumped out of me from the research is this. 55% of FirstCry's GMV comes from its own house brands.
Whoa, hold on. 55%.
More than half of every rupee spent on their platform is on a product they own.
That is shockingly high. Usually private labels are like a side hustle for a retailer. You know, the generic brand paper towels or the store brand pasta. It's maybe 10 or 15% of sales if they're lucky.
Exactly. For most retailers, it's a way to offer a budget alternative to the big national brands. For FirstCry, it is the majority of their business.
So what are these brands?
We're talking about brands like Baby Hug, Baby O, Cute Walk, Pine Kids.
I see Baby Hug everywhere. I honestly did not realize that was a FirstCry brand.
You're not alone.
I thought it was just a popular independent brand they carried, you know, like a Fisher-Price or a Grocco.
And that is the absolute genius of it. They have built these brands to stand on their own. Baby Hug has massive brand equity in India. Parents trust it. It doesn't feel like a generic knockoff brand.
No, it really doesn't.
But because FirstCry owns the brand, they control the entire supply chain. They design it, they have it manufactured, they import it, they ship it, they sell it.
Which means the economics are completely different.
Completely. When they sell a third-party brand, say a Fisher-Price toy, their gross margin might be 15 to 25%. They have to pay Fisher-Price for the product.
Standard retail markup.
But when they sell a Baby Hug stroller or a pair of Cute Walk shoes, the margins are upwards of 40 to 50%, sometimes even higher.
That is double the money on more than half their sales.
Sometimes more. And this changes everything. They aren't just a shopkeeper. They are a manufacturer that owns its own massive distribution channel.
And that gives them two things, right? Huge pricing power.
And a massive competitive moat.
A moat. Explain that.
A defensive wall against competitors. Think about it. If Amazon decides it wants to crush FirstCry, what can it do?
It can lower prices.
Right. It can lower the price of Pampers. It can lower the price of Lego. It can undercut them on delivery speed for those commodity items. But what can it do?
It can't sell Baby Hug.
It cannot sell Baby Hug because FirstCry owns it. So if a parent falls in love with the quality of Baby Hug, if they trust that car seat or they like the fit of those clothes, they have to go to FirstCry to get it.
Ah, so Amazon can't touch that loyalty.
Exactly.
Yeah.
Building a brand like Baby Hug takes years and years of trust. You can't just algorithm your way into a parent trusting a crib for their newborn.
That's a really, really good point. You can algorithm a cheaper diaper, but you can't algorithm safety and trust, especially with babies.
It's the highest stakes consumer category there is.
If I buy a bad t-shirt for myself, I'm annoyed. I send it back. If I buy a bad car seat, I'm terrified. The emotional stakes are completely different.
Precisely. And that trust is the foundation of their entire customer acquisition model. Which brings us to what the company calls its flywheel.
The flywheel. I love a good business flywheel. This is how they get the customers in the door, and I assume keep them there for a long time.
Right. Because as you noted, acquiring new parents is expensive. There's a very limited window where you are a new parent.
You're only a new parent once, well, per kid. But that window of, I am panicking and I need everything right now is pretty short.
And finding those people at that exact moment is the holy grail for advertisers.
Sure.
If you're bidding on the search term buy stroller on Google, you are paying a fortune for that click.
It must be one of the most expensive keywords out there.
It is. So FirstCry has built a system to catch them without necessarily paying for expensive Google or Facebook ads every single time. It's a multi-step process.
Okay, walk us through the steps of this flywheel. How does it start spinning?
Step one is content and community. This is crucial. They don't just sell stuff. They run a massive parenting advice platform. They have forums, articles, expert Q&As.
So they're a media company first.
In a way. Imagine a worried mom or dad at 2:20 a.m. Their baby is crying, has a fever, whatever. They Google, why is my baby crying? Or rash on baby's arm.
We have all been there. The 2 a.m. panic search is a rite of passage for parents.
Exactly. And where do they land? They land on a FirstCry article. Or they join the FirstCry community to ask other parents a question.
Ah, okay.
Boom. FirstCry has their attention. They haven't bought anything yet, but they are in the ecosystem. They are getting real value for free from the brand.
They came for the advice, but now they are looking at the logo. They're starting to trust the source.
Exactly. Then comes step two, which brings it into the real world. That's the hospital partnership we talked about at the beginning, the gift box.
The handshake at birth.
This is the physical touch point. You're in the hospital, you're completely overwhelmed, and here comes a nice box of goodies from FirstCry. It's a gesture of goodwill, but it's also a massive data capture event.
So they have you online with the advice, and they have you offline in the hospital. And I assume to get the box, you probably have to share some details.
Usually, yes. A phone number, an email, maybe the baby's birth date, and now they know exactly how old your baby is.
Which means they know exactly what you're going to need 3 months from now, 6 months from now, a year from now.
Precisely. They can market to you with incredible precision.
Right. And once that trust is built, FirstCry helped me when I was scared, or FirstCry gave me free wipes in the hospital, you move to step 3, commerce.
Now, you're ready to buy.
You need a stroller. You've already been on their site. You trust their advice. You buy it from FirstCry. You need clothes. You buy Baby Hug because you trust the platform and the brand.
And then, once you're a customer, they lock you in.
That's step 4, loyalty, the FirstCry Club.
It's a paid membership program. You pay an annual fee.
And once you've paid, you are psychologically committed, right? You want to get your money's worth in discounts and special offers.
So you stop shaking other sites. You just default to FirstCry for everything. It's the Amazon Prime effect.
It really is. Does the data show that this works? Do people actually spend more?
It works incredibly well. The average annual growth rate of revenue from their existing customers has been 47% over the last 3 years leading up to 2026.
47%. So once you're in, you're really in.
Once a customer enters the ecosystem, they don't just stay, they spend significantly more money every single year.
That is incredible retention. It's a cradle to preteen ecosystem. They've basically gamified parenting consumption.
They have, and because of this whole flywheel, their customer acquisition cost, their SAC, is much lower than their competitors.
Because they don't have to fight for your attention with an ad every single time you need a new shirt for your kid.
They already have you. They got you with the article or the gift box. The sale is just the last step in a long relationship.
Okay, so let's recap where we are. They are huge. They have a genius, data-driven store strategy. They own the brands that actually make the most money. And they have this incredible flywheel that traps parents in a loop of advice, trust, and spending.
Sounds perfect, doesn't it?
It sounds like a money printing machine. It sounds like they should be posting record profits every single quarter. But, and here comes the reality check, when we look at the bottom line, are they actually printing money?
Well, this is where we have to pour a little bit of cold water on the party.
Hit us with the numbers. Let's see the financial reality.
Despite all that dominance, despite the $76.6 billion in revenue, FirstCry has struggled with net profit. For fiscal year 2025, they still posted a net loss.
Still losing money after all this time and with all this market share.
Yes. Now, to be fair, the loss narrowed significantly compared to previous years. They're definitely moving in the right direction. The arrow is pointing up.
So things are getting better, but they're not there yet.
They're not in the black. And if you look at more recent trends, in Q2 of fiscal year 26, they showed a net loss of 35 crore.
35 crore loss in a single quarter, that is not pocket change.
No. And what's interesting is that revenue was up in that quarter. So they're selling more, bringing more top-line cash,
Yeah.
but they're still bleeding at the bottom line.
Why? I mean, that's the big question, isn't it? If they're selling these high-margin baby hug clothes and they aren't spending as much on ads because of the flywheel, where's all the money going? Is it just bad management?
No, I don't think it's bad management. I think it's a very deliberate strategic choice. It's a classic case of growth versus profitability. They are consciously choosing to spend heavily on three main things.
Okay, what's number one?
First, and most importantly, logistics.
Shipping costs.
But not just standard shipping.
Yeah.
Speed. We'll talk about the quick commerce threat in more detail in a minute, but the short version is FirstCry is terrified of being too slow.
Right, because of the instant delivery apps.
So they are aggressively building out a fast delivery network. They are trying to expand same-day or next-day delivery to 13 major cities.
Mm.
And that requires massive CapEx, capital expenditure.
What does that mean in practical terms?
It means building warehouses, buying trucks, hiring thousands of personnel, investing in cutting-edge logistics technology.
So they are essentially building a FedEx or a delivery inside their own company.
Effectively. And that is incredibly expensive. Building physical infrastructure costs a fortune up front, and you don't see the returns for years.
Okay, so that's a huge cash drain. What's
Yeah.
the second one?
The second drain is marketing. Even with the flywheel, staying top of mind takes cash. You have to keep the brand visible because the competition, especially from these new, fast players, is fierce.
You can't just rely on the flywheel. You still have to advertise.
You have to keep feeding the top of the funnel. And the third drain,
What's number three?
ESOPs, employee stock ownership plans.
Ah, the startup currency. Paying people with equity.
Right. Now, it's a non-cash expense, meaning they aren't literally writing a check from the bank account for this every month. But for accounting purposes, it shows up as an expense on the books, and it hurts the reported profit number.
Okay, so logistics, marketing, and stock options. But you said something interesting before.
Yes. And this is the nuance that is really important for your listeners to understand, especially if they're looking at this as a potential investment. This is the key to understanding their valuation.
Okay, let's unpack it.
If you strip out all the new bets and the expansion, and you look at just the India multi-channel business, the core business of selling stuff to parents in India through the website and the stores,
The part that's been around for a while.
that part is actually profitable. It is cash generating.
Wait, really? So the main business makes money?
Yes. The
Yeah.
core engine works. It works beautifully. But
Nice.
that profit is being taken and immediately reinvested to subsidize the international expansion and these new expensive logistics bets.
So the older, responsible brother is paying for the younger, wilder brother's college tuition.
That's a perfect analogy. The India business is the responsible adult with a steady job, making good money. The international business and the fast delivery network are the hungry teenagers eating all the cash in the fridge.
That makes so much more sense. So it's a strategic choice. They could be profitable today if they just decided to stop growing so aggressively.
Exactly. If they shut down the Middle East operation and pause the fast delivery rollout, they would likely be very profitable tomorrow. But they are choosing to bet on the future. They believe that if they build this infrastructure now, they will own the entire market for the next 20 years.
But betting on the future comes with risks. And this leads us directly to the elephant in the room. Or maybe, in this case, the cheetah in the room. Because we need to talk about speed.
The quick commerce threat. This is, without a doubt, the single biggest structural risk they face.
We're seeing this everywhere. Apps like Blinkit, Zepto, Swiggy, Instamart. If I run out of diapers at 6:00 p.m. and my kid is screaming,
Yep.
I cannot wait for FirstCry to deliver it in 2 days. I can't even wait 2 hours. I need it in 10 minutes.
Exactly. Diapers, wipes, baby formula, Calpol. These are high-frequency, urgent, low-margin items. And the quick commerce players are absolutely stealing that volume. They are training an entire generation of customers to expect instant gratification.
And it's not just the diaper sale they lose, right? That's not the biggest problem.
No, the bigger problem is the habit. If I open Blinkit to buy diapers, maybe I see they also have baby food. So I add that. Oh, and they have some basic toys. Maybe I'll buy a toy.
And suddenly FirstCry loses 3 sales, not 1.
That is the fear. If the commodity purchases the boring stuff you buy every week, move to quick commerce, FirstCry loses the frequency of interaction.
They're no longer the default app you open.
Exactly. They become the place you go for a crib, which you buy once, or a fancy occasion dress, which you buy a few times a year. They lose the weekly habitual touch point.
And if you lose the habit, you lose the customer's mindshare. You stop opening the app.
And that's deadly for an e-commerce business.
So how are they defending themselves? They can't deliver a crib in 10 minutes from a dark store.
No, you're right. But they're trying to get much, much faster on the essentials. Like we mentioned, this is why they're burning all that cash on logistics.
The defensive spending.
It's a purely defensive move. Their internal target is for 50% of all their shipments to be fast delivery by the middle of fiscal year 27.
That is extremely ambitious.
It is. And it's a tough choice. It drags down margins in the short term because it's incredibly expensive to ship things that fast. But if they don't do it, they risk losing a customer entirely to the 10-minute players.
It's a classic arms race, and if they don't participate, they get wiped out.
It is. And this isn't the only risk on the horizon. There is another one that is a bit more complicated. It's more of an internal issue. It involves a company called Brainbees.
I saw this name in the research, Global Bees. FirstCry invested heavily in them, correct?
Very heavily. Brainbees is what's known in the industry as a Thrasio-style roll-up company.
Okay, can you explain what that means for us?
The idea is simple in theory, but very hard in practice. You find small, successful, independent brands that are selling on Amazon or other marketplaces.
So like a guy who makes a really great yoga mat, or a family that sells a popular brand of sustainable coffee cups online.
Exactly. You identify these little digital native brands. You buy them, and then you use your corporate expertise in marketing, supply chain, and finance to scale them up. You roll them up into one big holding company.
And this was a very trendy business model a few years ago.
Very trendy. Everyone was trying to do it. And FirstCry bet big on this idea with Brainbees. They invested a lot of capital. But in June 2025, an insolvency plea was filed against Brainbees.
Insolvency, that is the I word you never want to hear associated with a major investment.
No. And while legal battles can get complicated, and sometimes these pleas can be negotiation tactics, the mere existence of it is a major red flag for investors.
Why? What question does it raise?
It raises serious questions about capital allocation.
Meaning, are they good at spending their money? Are they making smart bets?
Exactly. Investors look at this and say, wait a minute, you are great at selling baby clothes. Your core business is a machine? Why are you spending our money on this complicated roll-up experiment that seems to be failing?
It's a distraction.
It raises doubts.
Mm-hmm.
Are they good at buying and managing other companies? Or did they just get caught up in a trend and bite off more than they could chew?
It makes investors nervous. It looks like they took their eye off the ball, which is the baby business.
It does. It suggests that while the core baby business is fundamentally strong, their skills as a conglomerate or a holding company might be shaky.
And then on top of all that, there is the macro risk. The big one they can't control at all.
Demographics.
Babies, or more accurately, the lack thereof.
It's a global trend, but it's happening in India too. India's total fertility rate is dropping. It's gone from 2.4 down to around 2.0.
What does 2.0 mean in real terms?
It means we are at replacement level. The population is no longer growing rapidly. In some southern states, the rate is already well below replacement level.
So the obvious question is, does that mean they are running out of customers? If people have fewer kids, surely that's fundamentally bad for baby business.
Long term, yes, it's a headwind. You can't deny it. Fewer babies eventually means fewer diapers sold. But, and this is a very big but, the expert in me sees the powerful counterargument.
Which is?
Market penetration. For all their dominance, FirstCry is only reaching about 15 to 16% of the total addressable market in India.
Oh, wow. I thought it would be much higher. So 85% of parents are still buying from somewhere else?
Yes. The vast majority of the market is still unorganized retail.
The local mom and pop shop, the generic market stall, the neighborhood pharmacy.
That's where most of the business still happens. So even if the total number of babies born stays flat or even dips slightly, FirstCry has a massive runway to grow just by stealing market share from that unorganized sector.
So they can grow for another decade just by modernizing the existing market.
Exactly. They aren't running out of babies yet. They're just getting started on converting the parents of the babies that already exist. They're formalizing the economy of parenting.
Okay. So to keep that growth engine running, to keep convincing those parents to switch, they are looking for new frontiers.
Yes, and they're pushing in two directions at once. They are going abroad, and they are going deeper into the heartland of India,
Let's talk about the abroad part first. Where are they going?
the Middle East, specifically the UAE and Saudi Arabia.
Why there? What's the attraction?
High spending power and favorable demographics. Parents in the UAE and Saudi Arabia spend a lot of money on their kids, and the markets are growing.
And have they made any progress?
They've made huge progress. FirstCry is already the largest specialist online platform for baby and kids products in the UAE and the largest online first player in Saudi Arabia.
They are already leading in those markets.
They are. The international segment is now about 11% of their total consolidated revenue. But again, there's that trade-off.
It's not profitable yet.
It's currently loss-making. They are subsidizing it with the profits from the India business in order to capture the market. It's a classic land grab. They want to establish the brand and the infrastructure before anyone else does.
And the other direction, you said they're going deeper into India.
Yes, expansion into Tier 2 and Tier 3 cities.
The smaller towns and cities.
This is where the real volume of India's population is. And as these towns undergo retail modernization, as people get more connected and aspirational.
FirstCry wants to be the first organized modern player they encounter.
Exactly. So instead of buying clothes at the local bazaar, parents in a Tier 3 city can go to an air-conditioned FirstCry store or order from the app. It's a huge aspirational shift.
So the strategy is to be the first one to plant the flag in these modernizing towns.
Right. Now, the risk-reward is different there.
How so?
The purchasing power in these towns is lower than in Mumbai or Delhi, so the average basket size might be smaller. That's the risk. But the reward is that the competition is almost non-existent. You effectively own the town.
Okay, let's bring all of this together. We've covered a lot of ground here. The massive scale, the secret weapon of the private labels, the brilliant flywheel, but also the profit struggles and the very real risks.
It's a complex picture.
If you had to synthesize this for a listener, maybe someone thinking about investing or just trying to understand the Indian business landscape, what is the final verdict?
I see FirstCry as a dominant market leader that is currently in a very expensive and very deliberate transition phase.
Transitioning from what to what?
Transitioning from a high-growth startup to, they hope, a sustainable long-term giant. They absolutely have the secret sauce. That 55% private label mix is the envy of the retail world. That is their golden goose.
And the flywheel works?
The flywheel is real and it is powerful. The core business is sound. But they are currently burning that golden goose's eggs to fight a war on two fronts: the quick commerce war at home and the expansion war abroad.
That is a vivid image. Burning the golden goose's eggs to fight the war.
It's a high-stakes game. The pros are crystal clear. 55% private label, the flywheel ecosystem, clear market leadership.
And the cons are just as clear.
The cons are real. Executive turnover. We saw the Global Bees CEO leave, the insolvency issues in subsidiaries which raise governance questions, and the relentless, eye-watering cash burn for logistics.
So what's the final verdict? What is this company really?
It's a pure play on the formalization of Indian parenting. If they can eventually turn off the heavy investment tap, the profit is there. We know the underlying business makes money. But right now, they are choosing growth over profit every single day. They are betting they can become too big to fail.
And that leads me to a final provocative thought for our listeners to take away. We've talked about all the business mechanics, but think about the human side of this for a moment.
Okay.
In a world where fertility rates are dropping, where the total number of children per family is shrinking, FirstCry is building a business model designed to monetize every single aspect of a child's life up to age 12.
Right. From the first diaper to the last school uniform.
So are they just a retailer? Or are they trying to become a parenting tax, a service you simply cannot avoid if you have a child in modern India?
That is a fascinating way to frame it. A utility for parenting.
Think about it. You get the gift box in the hospital. You read their advice on your phone at 2 a.m. You buy their diapers. You buy their clothes. You buy their school bag. Can you actually opt out? Or is FirstCry becoming a utility like electricity or water for the act of raising a child?
And with the stumble they had with Global Bees, the question is, have they bitten off more than they can chew? Have they tried to tax too much of the ecosystem too quickly?
Exactly. So next time you see that baby hug label on a onesie or a stroller, take a second look. It's not just a cute brand, it's a piece of a massive, ambitious, and very expensive strategy to become the operating system of your family's life.
And that operating system is still being coded, still being debugged.
It is, and we'll be watching to see if it crashes or if it eventually runs smoothly. That's all for today's deep dive.
Thanks for listening.
See you next time.